This slideshow will help you structure your business for tax purposes. There are 4 different types of business structures with the IRS: sole proprietorship, partnership, S corporation, and C corporation. You may have heard of an LLC. An LLC is short for Limited Liability Company. An LLC is a legal entity formed under state law. If you become an LLC, your business structure for tax purposes still needs to be a sole proprietorship, partnership, S corporation, or C corporation. Why become an LLC then? The answer is because forming an LLC helps protect your personal assets. A member is not typically personally liable for the debts and liabilities of an LLC. Thus, your risk is usually limited to the amount you have invested in your company. This is definitely a wise consideration if you're going to start a business. Now let's look at the structure of your business for tax purposes. The first question to ask is, are you doing this alone? If the answer is yes, and you are not going to incorporate, you will be a sole proprietorship. In this situation, I would recommend becoming an LLC. Your income and expenses get reported on a Schedule C of your Form 1040. The net income, which is income minus expenses, is subject to self-employment taxes. This is calculated on Schedule SE. If you decide to go into business with another person or with a group, and you become an LLC, and you elect not to become a corporation, you will be a partnership. A partnership files a separate return called a Form 1065. You will be given a Schedule K1 with your portion of the earnings, which you will report on Schedule E of your Form 1040. These earnings will be subject to SE tax, which is Social Security and Medicare. This is reported on Schedule SE. I want to note an exception. If you go into business with your spouse, you can still file as a sole proprietorship and report your earnings on Schedule C. Incorporation is another option for your business structure. Benefits include that it helps protect your personal assets, like an LLC. This is because a corporation is a separate business entity in legality. Incorporation may also give your company the stature you are seeking. There's also a less chance of being audited statistically. One option, if you decide to incorporate, is becoming an S corporation. You can be the sole shareholder, or you can join with 99 other shareholders, as there is a limit of 100. An S corporation files a separate return called a Form 1120-S. Your share of the income will be reported to you on Schedule K1. You will report this income on Schedule E of your Form 1040. Unlike a partnership, your share of the income is not subject to self-employment tax. The fourth and final option to structure your business is a C corporation. A C corporation has no limit on the number of shareholders. The C corporation files a separate return called a Form 1120. The tax from the corporation earnings are paid by the corporation with Form 1120. Unlike an S corporation and partnership, the earnings are not passed through to the shareholders to pay tax on. If you make a withdrawal from the corporation as a shareholder, it is considered a dividend, and you pay tax on this on your Form 1040. This results in double taxation.